If you are serious about your portfolio for 2024, then get yourself to the Vancouver Resource Investment Conference in Vancouver, British Columbia on January 21st and 22nd.
Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. We're counting down to the VRIC January 21st and 22nd. There's a link in the description below where you can get your tickets. But we are, of course, bringing the VRIC to you with our series of expert online panels. And I'm very excited for today's. I'm joined by Warren Irwin, the president and CIO of Rosso Asset Management, and David Lotan, CEO of LHI Capital. And today we're going to be talking about metals and mining. Gentlemen, it's great to have you both on the show.
Thanks for having us, Jesse.
Thanks for having us, Jesse.
Yeah, great to have you here. I want to start with this narrative that's been going around for the past few years about a commodities supercycle. A lot of experts in the commodity space have been talking about this, that there's going to be a shift from the FANG stocks and the Magnificent Seven, overvalued tech. That's all going to roll over, and people are going to go after the new shiny object, which will be real assets in the form of commodities. I'm wondering how you both see that narrative. Is that close to the reality? Is it more complex and subtle than that? And David, I'll go to you first.
Sure, Jesse. I think that that certainly looked like a transition that was happening after 2022 when the NASDAQ was down 33% in a completely awful year. Also for mainstream equities in the United States, which had a similar performance. But of course, we're up 43% on the NASDAQ this year and probably very close to all-time highs, which were around December, January of 2022, 2023. So absolute garbage. Carvana, Peloton, the Goldman Sachs index of profitless tech has multiplied in value in the last year. I meant to look at ARC before we came on air to see how Kathy Wood did in last year, although I think she was a bit of a laggard. So it seems a little early to pronounce the death of U.S. fluffy NASDAQ stocks. And that being said, the world's inability to permit new mines, to bring new supply on, I think threatens to create bottlenecks for the next 10 or 20 years in some of the very crucial resources that society needs to flourish. And so I'm bullish on commodities, and I think that we're going to have a supply-driven bull market. Whether there's another Chinese miracle of urbanization that's going to come out of, for instance, India, I think it's a little too early to suggest that's going to happen.
And Warren, your thoughts. Are you bullish on commodities across the board moving forward? Are there certain commodities that you think will be more in demand than others? And do you also see this as a supply-driven bull market?
You know, Dave is exactly correct. When you see my perspective, it's based on, of course, my most reasonably recent experience back in the 2000s when the NASDAQ crashed, and then everybody looked around and said, "Well, that was a fun ride. Let's see what else is out there that's cheap." And right now, there are some very good similarities between the two, because as soon as the NASDAQ collapsed, people were saying, all right, enough with these baloney stocks that don't make any money, that had trade at multiple billion-dollar valuations. And it was quite a bit of a joke. I made some money on the upside and the downside. I was doing a bit of NASDAQ trading myself at the time when Rosso, in the early days of Rosso. But then the transition happened and things got rolling. And that was after a period of time, just to set the stage for it. When that transition happened, we had a rock and roll, super hot mining market from the early 90s till VRIC blew everything up around 96, 97 timeframe. So we had a really hot market. Then we had quite a number of years where, commodities were a dirty word. And then when the NASDAQ did collapse, people were looking around for real things, real value, things like that, right? So they came to the resource sector, and that's where we were able to get a pretty good run from about 2000, 2001-ish to 2008, 2010, to whatever you want to call the top on that. So I lived through that, and I think that's what I saw is people just blew their brains out in the tech market, and they were looking for something real and something cheap, and that was the commodities. And today, I did a graph the other day for my year-end review, a graph of the S&P 500 versus the Goldman Sachs Commodities Index, and I was able to go back to about 1970. So that's the last 50 plus years, right? Half century, right? And today, in relationship to the S&P 500, the Goldman Sachs Resource Index is at the lowest level in half a century. So there's great argument for that. And then you take a look at what would turn around tech? What would collapse tech to get people to focus on something different? And we're obviously seeing a lot of potential issues on the horizon. For instance, with Apple, these whole issues with Foxconn, what the Chinese are doing with Foxconn, and the supply chain and critical metals, and this whole. I would be very afraid right now if I was Apple building all my products in China. It would just not give me a great level of comfort, and just the whole thing around chips and manufacturing of high tech products in and around China and not in the good US of A, right? So that could be a really, really bumpy here going forward. But let's take a look at the issues like David touched on with respect to commodities. I was, before I got on this call, I was just thinking to myself about that type of question. And what you have here is, like David said, like trying to get a mine permitted is really, really tricky. And whether it be the NGOs going against you, the government's going against you, the most recent stupid regulations I've seen, which just, I wonder why I'm even in Canada anymore, is the Canadian government and their limitations on strategic metals and selling to the Chinese, right? So the problem we have, right, is Chinese are the buyers for a lot of these commodities, right? So that's a bit of a problem. But like Dave said, what's going to happen here is, all right, put all these rules against us miners, put tons of NGOs, shut down Cobre Panama, shut down everything, give indigenous band of 200 people 500 miles away from the project say as to whether the project goes ahead or not. Okay, fine, we could take that on the chin, but we're going to see it here when you try and build your Teslas or your electric cars, because there won't be any copper mines, there won't be any nickel mines, we won't have any of the critical metals that you'll need to accomplish what you're doing. So it's eventually going to happen.
And David, yeah, I just wanted to follow up on what you were saying, Warren, about NGOs trying to block mines, governments kind of turning socialist. You talked about the situation in Panama. A lot of South America seems to be plagued by issues. Mexico, I believe, putting a ban on new open pit mines. And before we hit record here, David, you were talking about some mines in Serbia that faced issues in the past as well due to NGOs. How do you think the pendulum is going to eventually swing the other way, I guess, is my question. Because a lot of these world leaders are talking about the energy transition, the new green economy, without really factoring in the amount of actual mining that needs to take place for that to happen. And a lot of them take completely opposite stances, where on one hand, they're talking about pushing the green energy transition, and on the other hand, they're completely against mining in all shapes and forms in their own country. Something's got to give. So what are your thoughts there?
Yes, I would agree. I think there's been sort of a collective delusion in Europe, Canada, and the United States, really in the developed countries in particular. Populations there have traditionally been very wealthy and very energy intensive. And I think there was this assumption that we could transition to renewables, untested, unreliable, unknown, and very high risk, and really give up almost none of our standard of living. And for a while, this proved to be true. And unfortunately for Germany, the lesson is being learned in the hardest possible way. It almost would seem like the war in Ukraine was a pretext to get Germany off of Russian natural gas. And the economy is deindustrializing now. It's in contraction. I think the damage that's been done to industry there won't be undone potentially for decades. A lot of these high-end manufacturing businesses in precision machinery and chemicals are leaving, and they won't come back. And so in places like Germany, the United Kingdom, where they turned off their nuclear stations, destroyed their coal-fired power plants, the standard of living is declining and the cost of living is going up. Canada and the United States, we really haven't had to face this yet. But if the goal of the administration in Canada and the United States is to electrify our vehicle fleets, the amount of raw materials that we'll need will drive costs up by a multiple across the spectrum.
The era of globalization has now come to an end. Countries and corporations are right now racing to secure the materials they need for their supply chains. If you are serious about your portfolio for 2024, then get yourself to the Vancouver Resource Investment Conference in Vancouver, British Columbia on January 21st and 22nd.
And I'd like to shift now to investment in the mining sector and ask where you're both seeing opportunity at present. And Warren, I'll start with you. Are there any particular metals or maybe even regions of the world or companies that you're watching at the moment that you think present an attractive value proposition?
Yeah, I'm seeing quite a bit of value out there. So it's pretty ridiculous, frankly, what I'm seeing. For instance, I'll take a look I'll give you some examples of some of my holdings that are super cheap. For instance, I'm a big fan of met coal. Met coal, it generates CO2, but there's no substitute for it in the next many decades. India is going to be doubling their steel production by 2030. That's only 7 years away, and they'll need twice as much met coal, right? And China is continuing to grow too. India doesn't have a domestic source, so met coal is north of $300 US a ton, and you're able to buy certain met coal companies today with resources in the ground, tier 1 jurisdiction, supportive of met coal mining, history of met coal mining, history of providing the smelters with high quality met coal, and you can pick that up for an in situ value of 40 cents, right? So you've got $300 when you yank the black stuff out of the ground, put it on a ship, and you buy it for 40 cents. So tremendous value. Also, with respect to copper, I'm heavily involved in a situation, or more, I guess not heavily, but more actively involved in a situation where we've got a world-class, one of the top 5 undeveloped projects in the world, trading at an in situ value of copper of 1 cent per pound. So you've got it, same story. You've got copper around 380, 390. And you're picking it up in the ground, already drilled out, resource, 1 penny, right? 1 penny. So that represents value. And then of course, I'm taking a look at the same story with nickel. Like I have a situation I'm aware of in the nickel space where the valuations are so outrageously cheap that it's pretty laughable. You've got drilled up resources to international standards, and the market cap's half of 2/3 of nothing. And I noticed recently we had a junior here. I won't name the name, but it just had a monster run to 400 million market cap on one little drill result, which was not followed up following that, but Here you have an instance in 3 cases I've just given you where we've got drilled up resources trading at pennies on the dollar. And it's incredibly cheap. And so when you take a look at it, that one graph I mentioned I did between the Goldman Sachs Resource Index versus the S&P 500, and it's the lowest it's been in over half a century. I'm seeing it on the ground, real world, super duper cheap stuff. And it's pretty outrageously cheap, frankly. So there's tremendous upside if the market turns for us.
Yeah, certainly opportunities out there if you know where to look. David, what about yourself? Which commodities are you currently watching that you think present an attractive opportunity here in 2024 and beyond?
Hydrocarbons, I think, are compelling in that they are the most hated of the commodity complex, and also prone to bottlenecks. Gas in the Permian getting produced as a matter of fact, and being almost a waste product. So interesting opportunities, disparities between European markets and US markets for gas, for instance, where the gas is stranded and it's difficult to get it to LNG ports. I, like Warren, think metallurgical coal is actually one of the most interesting commodities in the world right now. It has unfortunately been painted with the thermal coal brush, even though it is, along with copper, nickel, and cobalt, maybe one of the most important commodities for society's stated desire to transition to new forms of energy. And as a result, you have the industry stretched across the rack by NGOs, unable to get bank loans in most countries other than from China, and I guess there's still financing coal mines out of Australia, but it's really, really difficult to get financing for a met coal development at the moment. Nonetheless, the assets, when they trade, BHP's assets in Queensland to Whitehaven, or the Teck sale to Glencore, these assets trade for billions and billions of dollars. So that's one example of a commodity that I think is viewed by industry participants, and by that I mean the steel companies, as being in supply distress already. Viewed by investors, it's a no-go. So there are other examples. I'm bullish of almost all hard assets at the moment, but that would be the one that is most unfairly, that has all the odds stacked against it in a completely nonsensical manner.
And what does it take to bring investors and serious investment capital into these sectors that are so hated for ESG reasons, painted with a broad brush as just being bad for humanity? You mentioned hydrocarbons there. I completely agree with you on the oil and gas space. What does it take? Because sometimes we see these incredible valuations and the stocks don't move because not enough investment is going into them. Do you think that's going to take a shift in the zeitgeist regarding the whole ESG narrative, that perhaps the pendulum will swing, that will fall apart? People will realize that, we need commodities to advance as a civilization. And David, I'll go to you first on this one and then get your thoughts, Warren.
Inflation. Persistent inflation. It's already happening. You can see all of these governments in Scandinavia, the Netherlands, Germany at the local level, France, all swinging to the right. And this is merely a reflection of an increase in the cost of living. There's some other nasty factors going on out there related to immigration, the war in the Middle East. But for all intents and purposes, when voters have to pay more for gasoline and food, they throw at the government.
And Warren, your thoughts?
Well, I've generally found investors are at the end of the day, they're very greedy. And if they eventually start seeing their buddies making lots of money in a certain sector, they're all going to pile in, right? So for us to do that, we need possibly higher commodity price. So we need something where somebody looks at the returns earned in resources, and people, that's a place we should be looking at. We just, tech's not doing too great. It doesn't look like it's got much upside from here. Let's take a look at resources. They tell their kids in the analytical department, hey kids, take a look at some of these resource stocks and find out the sectors to invest in. And to give you an example too, right? When you look at the last 13 years, 7 of those years, the worst performing sector of 7 of the last 13 years is the resource sector, right? So it's been just pummeled, and there's no reason for any sane individual to jump into the resource sector having looked at the last 13 years. But as a lot of the old timers, and I'm pretty freaking old, but there are some older people than me going, well, Warren, the longer we go where resources are out of favor, specifically mining, you know, the bigger the bull run we're going to have. And so we've been going a fair amount of time here where resource stocks have been really out of favor. And so when we get a tick up, start getting ticks up in commodity prices, that'll be, when people start making some money, it'll be like a bean pile. Everybody will jump in and say, all right, let's do it. And I remember the last run we had, you know, to kind of throw in some optimism here, like the run we had from 2000 to 2008 or 2010, 12 range, whatever you want to call the end date. It was wild. It was amazing. And you could be pretty much an idiot and make a ton of money in the resource space. And, you know, I was also involved in some pretty good runs back in the 90s, the bull market in the resource sector in the 90s. So we haven't seen one of those in a very long time, and we're definitely due. And certainly there's not a lot of downside here because valuations are so damn cheap. So.
And how can your average, oh, go ahead, David.
Yeah, sorry, Warren's exactly right. And I would add, we're seeing short bull markets now in commodities, not the long markets that we saw in the 90s and the one that sort of persisted off of the 1999 or 2000 NASDAQ crash that went fairly uninterrupted until the global financial crisis and then continued to 2011. But if you bought anything related to oil and gas in April of 2020, you made a fortune. You could throw a dart. And we didn't have a continuation of the energy bull market in the last year, but people, investors who bought tourmaline, for instance, at $7 a share, watch it go to 80, have had $13, $14 of capital returned to them already. So, and then when you look at the bull market we had in gold equities off of the COVID bottom, gold equities went parabolic from, let's say, May of that year until there was an announcement of a vaccine. And they've been in a long decline ever since. But I mean, many of the gold companies doubled in price in just a few short months. So my expectations going forward are that we will continue to have these short, sharp movements up. There will be often years-long retracements, but we won't give up all the gains. And all this will resolve itself with a monster bull market at some point. But I don't know when that one turns up.
And how can your average retail investor kind of wrap their head around the space? Obviously, most people should probably not be picking individual equities. I think the type of people that come to the Vancouver Resource Investment Conference and watch a channel like this are the type of people who are likely to try and pick equities. So for such people who have the inclination, who have the time, and who have the resolve to actually educate themselves, what do you think are the most important factors that they need to take into consideration when evaluating mining stocks? And Warren, I'll start with you.
Okay, we want to specifically look at the juniors, right? We'll skip the majors.
Sure.
And just before we get into that, one important thing I've obviously noticed, and David touched on a little bit, is what we've seen here recently is kind of unusual in that we've had the hype on cobalt. Cobalt ramped, collapsed. We had the hype on lithium. Lithium ramped, collapsed. We've had the hype on, they seem to be doing a bullet approach, rifle approach to the sector, going, let's jump in this commodity. Everybody piles in, they run it up, they sell, collapses. And there hasn't been the big broad run yet. And it's fascinating right now. I'm seeing it in uranium, where we right now have 85 million pounds in spot and yellowcake. And then I just was reading over the weekend where 50 hedge funds have, in addition to that, already have funds in uranium stored at Converdyn, right? So the uranium market's not that big. So when you're taking like 85 million pounds, which is, annual production is around 135, 140 million pounds. So you're taking more than half a year's production out of the market just in two vehicles. So that's obviously the next one in the crosshairs, right? So they're going to ramp that up. How far it goes, who knows? When it collapses, who knows? So it's been very much a boom, 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 boom. Now, as far as back to your original question, let's taking a look at how you analyze a company. I think recently I've come across a company which is a good little case study. If you're just starting the business, what I would do is take a look at this company, make your own conclusions. Don't take my conclusions, but take a look at, let's say, premium nickel, okay? So if you do a top down, you go premium nickel. One of the top mining jurisdictions in Africa, Botswana, you look at locally, local support for mining. There have been mines in the past. People have worked in the past. I've been there myself. And locals are looking for jobs in mining. People know the prosperity of mining. And you go boom, 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 all the way down the line. You go, well, is there infrastructure? There's infrastructure. There's hydropower, rail, everything you need to build a mine. And then you go, well, do you have a deposit? Well, you do. We have some significant underground infrastructure. And well, grade, do you have grade? Well, we have grade. And you have intercepts. And we do have intercepts. We have tons. We have, there's historical tons. And you just go boom, 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 right from the top down. And then you find out, well, okay, well, seems like there's a lot of things with respect to support locally, federally. It's great jurisdiction. They already have a mine permit, so don't worry about that permitting issue. There's no indigenous issues. You've got support of the U.S. government through their strategic metals group. And you go boom, boom, boom through all that, and then you go, okay, well, you will have gone through every single major thing that could screw up a junior. We're looking right now at let's say at the top, Panama. While they're screwing up, Cobre Panama is getting destroyed. You look at locals. Well, the locals aren't burning down buildings and setting tires on fire on the roads. And you go, well, permitting. Well, permitting. They've already got a permit, so there's no permitting issues. You're not going to delay the project another 3 to 5 years to get a permit. And infrastructure, well, we're not building this thing in the Arctic, so it's an interesting case study, because what it does is it goes through every single factor that could hang up a mining project. And it's a very interesting one-stop place. You could take a look at all the key factors, and one by one, you could judge where they are. And I'll leave it up to the investors to do it. But that would be a really good case study for a beginner to take a look at, and just go through the whole process and everything that could screw up a project, and see how the premium nickel is dealing with those issues, and how it differs from any moose pasture metal company up in the Arctic somewhere, which has got quite a number of different challenges, like everything from First Nations to environment to infrastructure to global warming with respect to the lack of ice roads and things like that. So that would be a good place to start.
Great. And David, any sort of words of wisdom you might have for somebody wanting to approach the sector in terms of evaluating individual equities?
Well, I think we're sort of in a golden time for retail investors in the commodity space, because there's so little competition, and this interesting intersection between this sort of horrid bear market in capital availability for natural resources and the creator economy and all these multimedia platforms that are available on the internet. So I think it's fantastic that Warren is giving away all these fantastic ideas for nothing. And you can go back and look at the original article that Tommy Humphreys wrote on Warren's ranch about NextGen. And I think NextGen was a 50-cent stock back then. And Warren laid out the case for it. And it was really, really a success driven by retail, brick by brick, as investors started to pile into that stock, led by thought leaders like Warren, who are making their ideas available for nothing. And that's just where the industry's gotten to. You used to get up on Monday morning and see a run in a stock, and then go and see, who had published a letter on Sunday night. Was it Brent Cook or Eric Coffin, who dropped an idea? But it was too late because the stock had run that day. Stocks don't run anymore when industry experts go on YouTube or publish a letter and recommend the name. And so it's very easy, frankly, right now to find quality names, because the experts in the industry are not valued by retail or institutional investors. And as a result, they're adding as much value as they can through social media in order merely to attract followers. And I mean, this is not the case for Warren, obviously, but I've benefited tremendously from Warren's ideas, which he's made public, including cloning of coal and NextGen. And so I think right now there's never been a better time to go into resource small caps. It doesn't mean that there isn't a lot of work to be done, but the information has never really been more available, and historical comps are pretty compelling.
Yeah, I completely agree with you. Social media as well, obviously, can all be a double-edged sword, but using it as a complement to your own due diligence as opposed to the source of your due diligence, I think is a great way to just add an extra layer of evaluation onto companies you're looking at. I mean, you can look up the cash tags on Twitter sometimes. I ventured into the very obscure world of oil tanker stocks, and I got a lot of help on due diligence from some accounts on Twitter. There's definitely more information than ever out there, as long as you know where to look, and you have a strong fundamental case based on work you've put in yourself first. I want to get both your thoughts on gold here, because obviously reaching all-time highs, nominal highs, as Rick Rule corrected me last time I talked to him. A lot of people are kind of sentiment went back down again when the gold price went back down, but now we're looking at gold $2,000 as a support level for gold, which I think puts it in a very good position, particularly in the face of real positive interest rates, which is a situation where gold tends to underperform. Despite the performance of the metal itself, the miners have seemed to languish. A lot of people expecting them to perform much better. So talk to us about both gold's price action and your view on gold equities at present. And Warren, I'll throw this to you first.
Yeah, I have an interesting relationship with gold. I've made most of my money in my career investing in gold. And oddly, right now I have virtually zero gold on my books. So I'm just not finding things super interesting to get involved in the junior space at the present time. I remember one of the last ones I looked at was Ari Sussman's new deal in Colombia, and I'm going, Ari's a good guy. I've known him for years, and he looks like he's got a good team, a good project. I look at it and go, oh, Colombia, do I really need to deal with that again? I'm just getting too old for this stuff. So I passed on that deal, but the stock's done well, but so it just gets tiring after a while to see the same themes with respect to, the difficulty in getting, mines moving forward, and so for whatever reason, I have not found a good gold name for me to put my name behind and get behind in a big way. I view gold as just a long-term store of value, not a way to speculate and make a ton of money. And it's been that way for quite a number of years. There's been some runs intermittently, like the early 80s. You could have ran up again. They ran up to $800, collapsed down to a couple $100. There was some money made there, but generally where I've done well is in the gold bullion sense. I just buy gold bullion, park it away, and forget about it. And it has this trend line that follows the printing of money in general, and you're above and below that trend line based on speculators, right? Some people, they like to run the price of gold above that trend line, and then you get the Indians will take some of their gold and sell it, take it back down to the trend line or below it, and the Indians are really good at buying it cheap, and then they'll ride it back up and sell it above the trend line again. So I think it's just got a nice trajectory along with the money printing machines, and it's a good place to be. But it's been difficult for me personally to find good gold names, and so that's why I really don't have many on board. I am looking, and but to find the things like we talked about with that premium nickel, a good country that's not going to take your property away, it's not going to give you problems, supportive local people, no NGOs trying to screw you up, no indigenous people trying to screw you up. with infrastructure, with support of local people, and you take a look at all those things, and even the chance of getting permitted, right? So by the time you go through that, there's not many companies that make that, and it is quite a difficult place right now. And I'm absent from it because I just see tremendous value in other places where we've got drilled up resources at super cheap prices. So I'm hoping to get back into the gold market. So we'll see what happens. I'm going to continue to look at gold juniors. So.
And David, your thoughts on gold and where you see the equities positioned at present. And I'd also like to get your thoughts on royalties, if you think that's an area that presents a compelling value proposition. Ironically, we saw Franco-Nevada's stock kind of crater due to their exposure to the mine in Panama, where the whole point of investing in a royalty company is supposed to be so you spread the risk out. But they had like 17% or something of all their royalties in Cobre Panama, which in hindsight may have been a mistake. So I'm wondering what you think about that situation in particular, and gold equities, and perhaps touch on the royalties. And then Warren, I'd like to get your thoughts on the royalties as well.
Sure. Well, I'll start with royalties. I think that is the one area in the precious metals market that is overserved by investment capital. There is no lack of capital available for Franco-Nevada, Wheaton, Precious, Royal Gold. The promoters could see that lineup of investors trying hard to get into those equities, taking the PEs and the multiples to cash flow up to 30 to 50 times. And so a couple of years ago, they created a whole bunch of new royalty companies, VRIC and Volatile, Triple Flag. There were a whole host of junior resource or junior royalty companies that followed in the wake of that didn't quite make it across the line. And so for a brief moment, there was this interesting market where you had mid-tier royalty companies that were incredibly well valued, and the big guys, and really not much else. VRIC is now gone. Nomad, which was created during that period, is now gone, and the investor passion around small royalty companies has, for the moment, subsided. I think that will change going forward. I think, for instance, Metallica's acquisition of Nova Royalty was actually quite smart, and when investors regain their enthusiasm for junior or mid-tier royalty companies, I think some of them will perform quite well. Gold overall, the gold equities are a tricky market. Everyone seems to have missed the incredible move in gold equities from the beginning of COVID until the announcement of the vaccine. If you blinked, I suppose, you could have missed it. But it was the move that drew the generalists into the space. Oil looked like it would trade for nothing for years as we stayed in lockdown, and gold looked like it could go to the moon as we printed money in order to keep people in food and necessities while they were locked down. And then very, very abruptly, that narrative changed. And a lot of generalist money got stranded in that move. And it has been clawing and scratching its way out of that market ever since. Along the way, the gold majors have been consolidating and putting inventory on the market, as Newmont has now after taking over Newcrest, and reducing the number of competitors for projects. And that isn't a big problem because there aren't a lot of great projects out there. I can think of 5 or 6 really fantastic discoveries right now. All of those discoveries have their issues, but that's about it. There's $250 billion worth of market cap in the gold producers. Some portion of that, at least 25% of that, in my view, will be made available to refill the project pipeline. You can already see it happening now with mergers like Calibre taking over Marathon Gold, or the guys at Osino throwing in the towel and selling Twin Hills to Dundee Precious, and some of the gold juniors, some of the developing companies like I guess Nighthawk and Manita merging, or Millennial and Integra merging. So I think that's a very interesting market, and I think ultimately, if we're going into decades of persistent inflation, gold is a great investment, and the gold equities have a major bounce coming at some point But of course, timing is always the tricky part.
Great. Well, Warren, I'll get your thoughts on the royalty space when it comes to precious metals. Then let's wrap things up. So let us know your thoughts on the royalties here, and then let the viewers know where they can find you online if they want to hear more from you.
Okay, well, the best places for me is on Twitter. On the gold royalties, like, I remember historically back in the 90s, we had big US institutions playing the junior resource market, and they had their heads handed to them. So I think they've learned from that lesson, and they find that probably the safest way to play it is through the royalty companies. That being said, Franco made a very rare misstep with, or if it was their fault at all, having too much exposure to Cobre Panama. But in general, the royalties have performed very well for, big institutions that just don't have the specialty to do the deep dives. And it's been a good performing part of the sector. It's safe, it's liquid. So for a lot of players, it's not a bad place to be. So for me, there's not enough risk in it for me to get too excited. But it's been a really good place for a lot of people, and so I don't really have a knock on them. And I think in the future it'll continue to be a reasonably safe haven, liquid, safe, and reasonably decent performance. But if we have a rock and roll bull market, as David and I expect is overdue here at some point, I think the people who are taking the higher risk will be the ones that make the most money. But royalties aren't a bad spot to be. They're nice, and they're generally reasonably safe, perform reasonably well. So for a lot of people, that works for them.
Great. And Twitter is It's Warren Irwin. I will put a link to that in the description below. David, for people who want to hear more from you, where's the best place to go online?
No place.
Well, right here on the VRIC channel. Perfect. We've got the exclusive access.
This is it, Jesse. No, I don't have an online presence, and I'm full of admiration for people who are willing to go out on social media and put their views out as Warren does, but I would find that way too stressful. So I do the odd podcast, and I'm grateful for the invitations.
Yeah, well, it's been an honor to have both of you on. I learned a ton. I know everybody watching did as well. The mining space is a very tough business, so getting insight from experts such as yourself is of great help. So thank you both so much for coming on the channel and sharing all of your knowledge.